Hey everybody, it's Ron, and I want to tell you a story about business and how that story changed everything. It's Philadelphia in 1791. The Revolutionary War is over, but the country, it's broke. The United States owes money at home and abroad. Each individual state seems to have their own currencies, and they're trading all at different values. Credit is inconsistent, trust is fragile, the nation exists politically, but financially, it's still pretty scattered. Inside a quiet room, and no, it's not the room where it happened, Alexander Hamilton is arguing for something that most Americans, they just don't trust, and that is a national bank. Now, that idea isn't to control farmers or to enrich merchants. It's to stabilize debt, standardize money, and give the United States something it doesn't have yet, which is coordinated financial credibility. Critics call it unconstitutional. They also call it dangerous. They warn that concentrated financial power will eventually serve insiders over the citizens. Even so, President George Washington signs the charter. For the first time, the U.S. federal government is directly coordinating its banking system. The argument doesn't end there, though. It never really will, because every generation of Americans will wrestle with the same question. Who should control the money? And on March 3, 1863, in the middle of a civil war that threatened to tear the country apart, the next great president, President Abraham Lincoln, would answer that question again. Okay, so wait. If Hamilton convinced Washington to create a national bank in 1791, why is Abraham Lincoln rebuilding the national banking power 70 years later? Well, that's because Americans never fully agreed with Hamilton. The first Bank of the United States, which is what it was called, was chartered to last only 20 years. And when that charter expired in 1811, Congress chose not to renew it. They considered it too much centralized power, too much suspicion that financial elites would control the system. But just a year later, the War of 1812 broke out, and that exposed financial disorder, so Congress tried again. The Second Bank of the United States was created in 1816, and that one lasted just long enough to become politically explosive. Years later, President Andrew Jackson saw the bank as concentrating privilege. In 1832, he vetoed its recharter. He framed the fight as ordinary Americans versus financial insiders, and he won. By 1836, just 4 years later, the second bank was effectively gone. What followed is often called the free banking era. State-chartered banks multiplied. They were everywhere. But here's the thing. Each one issued its own paper currency. A merchant in Ohio might accept a note from a local bank at full value, but they would accept one for less value from a distant state. Newspapers published what were called banknote reporters, which listed which currencies were reliable and which ones were kind of suspect. Counterfeiting was common. The country functioned, but really unevenly. Trust depended on geography, and stability depended on local reputation. America had rejected centralized coordination again, and then came the Civil War. By 1861, the United States was not just divided politically, it was financially unstable. The Civil War was expensive. Armies had to be fed, equipped, transported on both sides of the fight. The Union, it needed cash, and it needed it fast. And here's the thing. President Abraham Lincoln couldn't fund a war with a patchwork of state banknotes trading at different values. He needed a reliable way to sell government bonds, which helped raise money, and create consistent currency. The solution was not to recreate Hamilton's centralized bank, though. Instead, Congress passed a different kind of system. The National Banking Act of 1863 allowed banks to apply for federal charters. In exchange for issuing nationally recognized banknotes, what we think of as U.S. money, those banks were required to purchase U.S. government bonds and hold them as backing. It was a clever structure. Banks gained credibility by issuing standardized notes. The federal government gained a built-in market for its war bonds. Coordination and financing became linked. And here's the thing, this wasn't ideological reconciliation, it was a wartime necessity. On March 3, 1863, Lincoln signed the National Banking Act into law. America once again had a centralized financial coordination, not because it fully trusted it, but because crisis made fragmentation too costly. Now, when that act was signed into law, the new national banking system didn't eliminate instability overnight, but it did standardize currency across much of the country. National banknotes carried consistent design and federal backing. That made counterfeiting much harder. Trust became less dependent on how far the notes were from where they were issued. Over time, a national market could function more smoothly. Still, it wasn't completely smooth sailing. There were still financial panics that followed. There was the Panic of 1873, the Panic of 1893, and especially the Panic of 1907, when banking instability once again exposed some structural weaknesses. The lesson just kept repeating itself. Decentralization created flexibility, but it also created fragility. After that crisis of 1907, lawmakers concluded that coordination alone wasn't enough. The system also needed insulation from short-term political swings. So in 1913, Congress created the Federal Reserve System, what we think of today as the Fed. It was designed to coordinate monetary policy while operating within a structure that was independent from day-to-day political pressure. The United States had cycled through central banks, destroyed them, rebuilt coordination under stress, and finally engineered a version meant to survive elections. The Federal Reserve was designed differently from the banks that had come before it. It didn't issue consumer loans. You can't walk into the Federal Reserve and open a checking account. It doesn't operate like a retail bank. Instead, it sits at the center of the financial system. The way I explain this to my students is the Fed are banks' bank. When a bank needs a bank to do business with, that's who they go to. The Fed manages the nation's money supply. It sets what's called short-term interest rates, which affect everything from credit card rates to mortgages to car loans. It supervises large banks. In times of crisis, it acts as a lender of last resort, providing liquidity when private markets freeze up. Just as important as what it does is how it was structured. Its leaders are appointed by elected officials, but they serve long, staggered terms. That way, change of administrations doesn't affect the leadership of the Fed. The Fed budget doesn't depend on annual congressional approval. Its regional reserve banks distribute authority across the country. The goal was stability, not to remove politics entirely, but to prevent monetary policy from swinging wildly with every election cycle. America had learned something over more than 150 years of trial and error. Fragmentation creates friction. Centralization creates power. And durable financial systems require coordination that can survive political mood shifts. But that lesson wasn't obvious in 1791, it wasn't settled in 1832, and it was not peacefully resolved in 1863. And one of the many steps along the way happened when Abraham Lincoln signed the National Banking Act, which once again at that time centralized American banking power when fragmentation could no longer sustain the nation. And he signed that act on March 3, 1863. I'm Ron Trucks, and this is Business History, the podcast that finds the turning points behind the headlines. To hear more stories like this, follow us on Apple Podcasts, Spotify, YouTube, or wherever you listen. And if you're enjoying the stories, do me a favor. Please don't forget to subscribe and leave a quick review. It helps more people find the story behind the business. And if you'd like to actually understand business better without the fluff or the buzzwords or the MBA language, start by visiting us at businessdailypodcast.com.
If you're shopping while working, eating, or even listening to this podcast, then you know and love the thrill of a deal. But are you getting the deal and cash back? Rakuten shoppers do. They get the brands they love, savings, and cash back. And you can get it too. Start getting cash back at your favorite stores like Target, Sephora, and even Expedia. Stack sales on top of cash back and feel what it's like to know you're maximizing the savings. It's easy to use, and you get your cash back sent to you through PayPal or check. The idea is simple. Stores pay Rakuten for sending them shoppers, and Rakuten shares the money with you as cash back. Download the free Rakuten app or go to Rakuten.com to start saving today. It's the most rewarding way to shop. That's RAKUTEN. Rakuten.com.
Adobe Acrobat Studio, so brand new. Show me all the things PDFs can do. Do your work with ease and speed. PDF Spaces is all you need. Do hours of research in an instant with key insights from an AI assistant. Pick a template with a click. Now your prezzo looks super slick. Close that deal? Yeah, you won. Do that, doing that, did that, done. Now you can do that with Acrobat. Now you can do that with the all-new Acrobat. It's time to do your best work with the all-new Adobe Acrobat Studio.
Life is unpredictable, but preparing for the unexpected shouldn't be. Take ownership of your life planning with Policy Genius to help your loved ones have a financial safety net in case something happens to you. They offer life insurance policies starting at just $276 a year for $1 million in coverage. Don't wait for life to make other plans. Protect your family today. Head to PolicyGenius.com. That's PolicyGenius.com.